Hello and welcome. One of the biggest and most daunting questions in personal finance is, how much money do I actually need to retire? It can feel like this giant, mysterious number that's just impossible to pin down. You might hear figures thrown around like $1 million or 10 times your salary, but where do these numbers even come from? And are they right for you? What if I told you there's a surprisingly simple, research-backed rule that can give you a clear, actionable answer? It's called the 4% rule, and it's the closest thing the financial world has to a retirement calculator cheat code. In this video, we're going to demystify this famous rule. We'll explain exactly what it is, where it came from, how you can use it to calculate your personal retirement number, and, crucially, its important limitations. Let's find your number. First up, what exactly is the 4% rule? Think of it as a guideline for creating your own retirement paycheck. It was developed back in the 1990s by a financial planner named William Benyon, and it's been tested and debated ever since. Here's the core concept. The rule states that if you withdraw 4% of your total retirement savings in your very first year of retirement, and then adjust that dollar amount for inflation each year after that, your nest egg has a very high probability of lasting for at least 30 years. Let's make this concrete with an example. Imagine you've worked hard and you've saved up $1 million for retirement. In your first year, you would withdraw 4% of that million, which is $40,000. That's your income for the year. Now, let's say in the second year, inflation was 2%. You wouldn't take 4% of whatever your new balance is. Instead, you'd adjust that original $40,000 amount upwards by 2%, giving you $40,800 to withdraw. You'd continue this process, adjusting for inflation each year for the next 30 years. The magic of this rule isn't really the 4% itself, it's the underlying logic. The idea is that your investments, even after you take out money each year, will continue to grow at a rate that, on average, outpaces your spending. You're essentially living off the returns of your portfolio, not draining the principal itself. A great way to think about it is that your retirement portfolio is a goose that lays golden eggs. The 4% rule is a strategy designed to help you collect just enough eggs each year without ever having to harm the goose. It's a rule for creating your own personal pension plan. Now for the most powerful part of this whole concept. We can actually flip the rule around to calculate your savings goal asterisk before asterisk you retire. This is how you find your personal magic number. Instead of starting with a big pile of money and calculating your income, we start with the income you asterisk 1 asterisk in retirement and calculate the size of the pile you need to build. The formula is incredibly simple. Take your desired annual retirement income and multiply it by 25. That's it. So why 25? Because 25 is the mathematical inverse of 4%. 1 divided by 0.04 equals 25. It's the same math, just in reverse. Let's walk through it step by step. First, you need to determine your annual need. Figure out how much after-tax income you'll need per year to live comfortably in retirement. This is honestly the trickiest part, and it requires some real, honest budgeting. But for this example, let us say you figure out that you need $60,000 per year to live your ideal retired life. Next, you apply the rule. You multiply that number by 25. So, $60,000 of desired income times 25 equals $1,500,000. That $1.5 million is your initial retirement savings target. It's the number you need to aim for. But wait, you might be thinking, what about Social Security or a pension? This is a fantastic point, and this is where the rule becomes even more powerful and your goal becomes much more realistic. Let's refine our example. You still want that $60,000 per year in retirement. But now, let us say you go to the Social Security website and estimate that you lines receive about $25,000 per year from them. That means your investment portfolio only needs to provide the gap. $60,000 minus $25,000 leaves a gap of $35,000. Now, we multiply that new, smaller number by 25. $35,000 times 25 equals $875,000. Now, it's really important to understand that the 4% rule is an excellent starting point, but it's not a perfect, guaranteed law of physics. It's a guideline, and to use it properly, you have to understand its context and its limitations. First, where did this rule even come from? The original study was based on historical data from the US markets. It assumed a portfolio mix of about 50% stocks and 50% bonds, and it was stress-tested against every possible 30-year retirement period in modern history. That includes the absolute worst-case scenarios like the Great Depression and the high inflation crisis of the 1970s, and in all of those historical scenarios, it held up. The money lasted. However, we all know the future might not look exactly like the past. So, here are the key caveats you absolutely must consider. First, the rule was designed for a 30-year retirement. If you're planning to retire early at, say, age 50, your money needs to last a lot longer. For a 40 or 50-year retirement, you might need a more conservative withdrawal rate, like 3% or 3.5%, which would mean you need to save more. Second, market valuations matter. When the original study was done, stock market valuations were generally lower and interest rates on bonds were higher. Some experts today argue that with current market conditions, a safer initial withdrawal rate might be closer to 3% or 3.5%, just to add a bigger margin of safety. Third, the rule is not set in stone. It's a plan for your first year of retirement. It doesn't mean you should blindly withdraw the same inflation-adjusted amount if the stock market crashes 40% in a given year. In practice, most retirees should be flexible. It makes sense to spend a little less in bad market years and maybe a little more in great ones. This dynamic approach can dramatically increase the longevity of your portfolio. And finally, the basic rule doesn't explicitly account for fees or taxes. The fees you pay on your investments, like expense ratios, and the income taxes you'll pay on your withdrawals will both eat into your returns. So when you're doing your math, you have to remember to account for these real-world costs. So, with all these caveats, should you still use the 4% rule? Absolutely. For anyone in the planning phase of their financial life, it is the single best tool to transform that abstract dream of retirement into a concrete, numerical target. It provides a fantastic baseline that you can then adjust based on your personal circumstances, your risk tolerance, and the economic landscape as you get closer to your retirement date. Let's do a quick recap. What is the 4% rule? It's a guideline stating you can safely withdraw 4% of your portfolio in your first year of retirement, then adjust that amount for inflation each year after, with a high probability of your money lasting 30 years. How do you find your number? Determine your desired annual income, subtract any other income sources like Social Security or pensions, and then multiply that final number by 25. And what are the caveats? Remember, it's a starting point, not a guarantee. You need to be flexible, consider a more conservative rate for longer retirements, and always account for taxes and fees. Knowing your number is empowering. It truly is. It replaces anxiety with clarity. Instead of just wondering, am I saving enough? You can track your progress against a specific, meaningful goal. The 4% rule gives you that power. So, I encourage you to do the math. Find your number. Let that number guide your savings strategy and give you the confidence that you are on the right path to a secure and comfortable retirement. Thanks so much for watching. If you found this helpful, please hit that like button and subscribe for more content that makes managing your money simple. See you next time.